Austrian economics is astronomy, and what everybody is learning today at universities is astrology, right? It's all a bunch of nonsense. Austrian economics is real economics, and it basically it has the focus on supply and savings, and it recognizes that the important thing is not the demand. Demand is infinite. Everybody wants stuff. The key is to produce stuff that people want. And where does production come from? It comes from capital. Where does capital come from? It comes from savings. So the important thing is savings. Savings drives capital investment. Capital investment drives production and productivity, and that ultimately allows consumption. The Keynesians have the cart before the horse. They think that demand is the key, and all their economic policies are designed to stimulate demand, and that's wrong-headed. We don't have to stimulate demand. Demand is there. We need to stimulate production, supply, and the free market does that, and the government interferes with that process. But also, one of the things that the Austrians understand is where the business cycle comes from, that it's not some natural flaw in the capitalist system, that the business cycle, the boom and bust cycle of recession, depression, is a byproduct of central bank artificial manipulation of interest rates. It's when the central banks keep interest rates artificially low, that's a rate that is below what the free market would put rates at. It leads to malinvestments and bubbles, and those bubbles inevitably burst, leading to the recession. And what the Austrians understand is it's the booms, it's these artificial periods of apparent prosperity that are the problem. That's where the mistakes are made. It's the bust, it's the recession that is the helpful process of cleansing the economy of the mistakes that were made during that phony boom. So the conventional wisdom is recessions are bad and the government needs to do whatever it can to prevent them. But the Austrians say, no, recessions are good. We need to allow them. Now, it's not that we want recessions, but once we make the mistake of creating a phony boom, the sooner that boom can bust, the sooner the problems can be fixed. But the way the Keynesians are, they never allow the problems to be fixed, because when one bubble pops, they quickly inflate another one so that we don't have to deal with the pain of correcting the problems. But then we're ultimately going to have to deal with the greater pain of correcting even bigger problems. And I think that's where we are now. We have kicked the can down the road so many years by trying to delay the pain that comes from a real reckoning with these mistakes and malinvestments, that now when we ultimately have to pay the piper, which we will, it's going to be so much worse. And I think, we're very, very close to that happening. I mean, I thought we were close a while ago, and it turned out that there was a little more can kicking that they could do. But if you look at where we are now with massive money printing, inflation blowing up, all the crazy stuff that's going on in the markets, from the meme stocks, to the cryptocurrencies, this has got to be the end of it. The Fed is at the end of its rope, and unfortunately, it's the economy that's going to hang. We should have learned, or there are probably some people that learned the lesson, but not the right people, not the people on Wall Street, not anybody at the Fed, or not anybody in government or academia. But the financial crisis was a byproduct of artificially low interest rates and the mistakes that were made during that environment. And the Fed did that to get us out of the recession that followed the bursting of the dot-com bubble, which again was inflated by the same wrong-headed policies. And when that bubble popped, the Fed doubled down on those mistakes and inflated the housing bubble. It was quite obvious to me what the Fed was doing wrong and what the consequences would be. I warned about the coming financial crisis for years. And not only did I warn about the crisis that was coming and why, but what the government was going to do in response. And of course, I was right again. The government tripled down on its mistakes. Instead of learning from them, like, oh my God, we kept interest rates artificially low and too much money was borrowed. to do non-economic things. We had too many people overpaying for houses. We had all people were consuming more than they should have because they thought they were richer than they were, because they were basing their wealth on these inflated asset prices that only existed because of the artificially low interest rates. So we totally distorted the economy. We created this massive bubble that was inevitably going to burst, and now we're having to deal with the consequences of all the losses from all the loans that never should have been made and never would have been made, but for our mistakes. Instead of learning that lesson, they just repeated the mistakes on a bigger scale. They didn't just raise rates to lower rates to 1%. They went all the way down to 0, and they left them there for 8 years instead of like a year and a half. And they never normalized rates. The highest they got was 2% or 2.5% before going right back to 0. And they threw quantitative easing into the mix, something that they didn't even do during the housing bubble days. They went all in and did that after that bubble popped. And so they have inflated today a bubble that is larger than the stock market bubble and the housing bubble combined. And it has done far more damage to the economy than either of those two bubbles. And therefore, the consequences when this massive bubble pops are far more severe than anything we experienced during the Great Recession that followed the bursting of the housing bubble. Well, the last two bubbles popped because the Fed tried to normalize rates. And, and when they did, they basically took away the punch bowl and everybody was hung over. And then all the mistakes were obvious. So this time around, I think the one thing that the Fed has learned from the past is you never do that. You can talk about normalizing rates, but you never actually do it. They don't want to take the punch bowl away. They don't want anybody to sober up, because then they'll see what a disaster the Fed has created. So this bubble is not going to burst because the Fed raises rates. It's going to burst because it doesn't raise rates. It's going to burst because the dollar crashes, because inflation runs out of control, ultimately either forcing the Fed to raise rates much higher and much faster than anybody would have imagined, or they don't raise them at all and we have hyperinflation, and the dollar becomes practically worthless. But this is going to be much worse and end much differently, I believe, than either of those prior to bubbles. So I think the most capitalistic period in American history would go from after the Civil War, so 1865, till maybe the First World War, the beginning of the Federal Reserve, 1913, around that time period. During that period of time, we had the freest markets, we had the purest gold standard, and that is when we had the greatest increase in living standards in U.S. history.